Can you hear me now? Yes. Okay, great. There's some seats up front here if anybody wants to come and sit up front. Well, welcome, ladies and gentlemen. This is a special session of the American Finance Association's program. This is an innovation. We historically have had sessions which have basically contained papers that were selected by the program committee, and it followed the usual format: paper, discussion, and so on. This year we decided to have 4 special, and this is a decision by the board last year. The 4 sessions, the first one was this morning on the financial crisis. This is the second session. There will be a third session which will be on ethics and finance, and a fourth session on what I call new areas. Biology and finance is the title of that session. I thought this particular session, which is the AFA lecture, would be a very important innovation in that it would give a platform for a notable and research-active member of the profession to give his views on a particular area, his or her views. Now, people ask, well, how is this different from the presidential address? And the reason it's very different is the AFA lecture could be delivered by anybody, whether they be president or not, if they're doing exciting work. So whether they be old, young, whoever is doing exciting work at whatever stage of their career could come up to this platform in a future year and give the lecture. But of course, we wanted to start the first lecture with somebody whose prestige is unquestioned, and of course, who is active. I asked past presidents for names, and it was clear from the names that I got that one name stood out. The clear choice was Andrei Shleifer, who I hope will be the first of an illustrious line of financial economists to deliver the AFA lecture in years to come. So, who is Andrei Shleifer? I think he needs no introduction, but of course, as soon as you say that, you have to go about giving a long introduction. Let me give you the brief introduction. He's a professor of economics at Harvard University, and his past affiliation, very important. He was a professor of finance and business economics at Chicago's Graduate School of Business, now the Booth School. He's written widely and has had enormous influence on the profession, whether it's in his work on noise trading, on liquidity, or on law and finance. And I can keep going. There are many subjects on which he has touched the field. In fact, there's hardly an area of finance where Andrei has not had an impact, and in fact, made the area better. Andrei has won many prizes and honors, including the John Bates Clark Medal, awarded by the American Economic Association in 1999. What is particularly astonishing to me is that his productivity seems as strong today as 20 years ago when he was a professor at Chicago. And incredibly, he's not writing the same paper over and over again. His ideas are fresh as always. And I'm sure you will see that in today's paper. Ladies and gentlemen, Andrei Shleifer.
Thank you very much, Raghu, for this introduction. It's obviously an extraordinary honor for me to be here. Raghu, of course, sounds extremely sweet and genteel when he introduces me. What he actually told me is that, that he's introducing this innovation into the AFA program or this AFA lecture, and he invited me to give the first one, and he said that, of course, if it's no good, that would be the last time that this lecture is likely to be given. So, of course, I'm feeling extremely mellow and relaxed. The topic of the lecture is the crisis. So what I will try to do, just in broadest terms, is to describe, first of all, the kind of what I think is the consensus or emerging consensus view of the crisis, but then try to go through and understand how the various theories of the crisis that we have, or the various explanations of the crisis we have, and to argue that some are considerably more plausible than others, and then go from there and say where this points in terms of what might be interesting directions for research in financial economics. So let me I will come back to all of this, quickly read what I believe to be the rough consensus view of the crisis. Housing bubble inflates in the mid-2000s. Homes are financed by mortgages that are increasingly securitized. Although the quality of mortgages deteriorates, the securities into which these mortgages are packaged are perceived to be safe and receive AAA ratings. Financial institutions such as banks and dealer banks retain substantial exposure to the real estate market through direct holdings of commercial real estate, direct holdings of MBS, but also implicit guarantees of special investment vehicles they organize, which hold MBS and finance them with commercial paper. Third, bad news about the housing market in the summer of '07 surprises investors in AAA-rated MBS and precipitates a sequence of substantial disruptions in financial markets, such as the collapse of asset-backed commercial paper market, aggressive liquidity interventions from the Federal Reserve, including lending to market participants against risky collateral, stabilized markets through the summer of '08, despite continued bad news about housing. In September '08, several events, including a run on money market funds, nationalization of AIG, Fannie Mae, and Freddie Mac, and particularly the collapse of Lehman, precipitated a massive financial crisis, a meltdown. Bank balance sheets contract because of massive losses on assets and withdrawal of short-term financing, which prompts banks to liquidate assets and fire sales. The consequences are exacerbated by uncertainty about bank solvency and government policy. In response to their losses and to reduced availability of financing, banks cut lending to firms. The economy slides into a major recession. And finally, starting in October '08, the government begins massive interventions in financial markets, including equity injections in banks, expansion of lending against risky collateral, but also direct purchases of long-term agency bonds, which sharply reduced the supply of risky bonds in the market. The combination of government interventions eventually stabilizes the markets by the spring of '09, although the real economy remains sluggish. Now, this is intended to be uncontroversial. And I realize there are some disagreements about some aspects of this story, but I think most reasonable people agree on some version of the story. So the question is, how do we piece it together? What is the theoretical narrative that accounts for these facts? Now, there are four broadly different interpretations, all of which I should say have to do with the asset side of the financial sector. And I'll talk about liability side a little later. And I will call them 100-year flood, too big to fail, agency problems and risk-taking inside banks, and neglected risks. So let me describe what these things are or what I mean by them. A 100-year flood is in some sense the most conventional explanation. It basically says that there are low probability events that happen once every 100 years, that the collapse of housing, it was one of these events, that there is nothing inherently wrong or particularly interesting about the financial system. It's just a thing that happened. The too big to fail story is a very important story, and it says that the people who ran the financial institutions, the managers of banks or dealer banks, were basically gambling with these institutions. And they were gambling because they realized that they're going to be rescued if things go south, if things go badly. So the essence of the too big to fail story is this conscious risk-taking by the executives of the institutions that got us into trouble, or that got into trouble. The agency problems and risk-taking inside banks is a story that I usually associate with Raghu's famous paper. And it goes roughly as follows, it says that traders and banks have compensation tilted to current profits, and they don't bear the consequences of the losses. The superiors do not fully understand the risks, and that creates an agency problem inside the bank, which means that traders, the people who are actually taking the risk, have a strong incentive to knowingly take exposure to such risks. In this case, the risks associated with CDOs or MBS or mortgages. And this risk-taking, this agency problem inside a financial institution, creates risks for institutions, and when all institutions take similar risks, this creates systemic risk. Okay? And the heart of this story is this internal agency problem, which is that the people who run these organizations are not informed about risk-taking, whereas the risks that are being taken, but the people who do take the risks actually have screwed up incentives, and so are willing to gamble because they can go elsewhere and they just want to get their bonus quickly. The fourth story, or the fourth theory that I'll be interested in, is what I call, what Nicola Giannaioli and Rob Vishny once called the neglected risk model, that basically says that investors assess risk historically and often or pretty regularly neglect probability non-salient events. So there are some things that simply do not come to mind, some risks do not come to mind. As a consequence, they see investments that by historical record have had attractive risk-return profiles as being attractive or as being worthwhile. Third, and very importantly, there are extremely powerful incentives inside the financial system to innovate and create securities that do have these characteristics, that look safe and attractive from the point of view of risks that people are thinking about, that people are focused on. When investors believe securities are safe enough, they also will lever up their investments, again, because they think they're involved in something like quasi-arbitrage. And of course, the combination of leverage and neglect of risk creates risk for institutions and systemic risk. Now, analytically, what's important about this story is that it doesn't emphasize the agency aspects. It basically says both the traders or the risk takers inside the institutions and the senior management of these institutions were simply, as well as the people outside the banks who were taking these risks, were unaware of the risks being taken to a first approximation. Now, one way, since this is a lecture, not a formal paper, to think about the neglected risk model, to illustrate it by analogy, which is a dangerous thing to do, is to think about the Titanic. Now, Titanic, as you all know, was a AAA-rated ship. It was described at the time it was built as the safest ship ever built, both in terms of engineering and in terms of the way in which various risks were controlled in the design. Very importantly, and this is just by contrast to the agency models, the insiders, the people who built the Titanic, the people who financed the Titanic, were on the Titanic during its maiden voyage. This is not the internet bubble where they sent unsuspecting passengers on the cross-Atlantic trip. They obviously believed it was safe. There were many rescue boats on board. But what was interesting, even though there were many rescue boats on board, they had the capacity to rescue 1/3 of the passengers that were on the Titanic during its maiden voyage. And in fact, and this I truly love, the number of boats it had was in compliance with the regulations that existed at the time about the number of rescue boats that a ship should have. It's just that the regulations were a little behind the innovations in the in the boat building sector. Now, there were rumors about icebergs being in that part of the Atlantic, and Titanic took a slightly southern route because there were warnings about these icebergs. What was interesting is that there were many radio warnings as well when Titanic, from other ships, when Titanic entered dangerous waters, and they were relayed to the radio crew on the Titanic, but that radio crew did not think they were important enough to actually convey them to the captain and to the senior management of the Titanic. Now, as you all know, after the collision, 2,000 passengers died. It turned out that some of the rescue boats were not fully packed, and just to go back to the crisis, nearly every single member of the crew went down with the Titanic. So this is an alternative model that doesn't emphasize agency, does not emphasize intentional risk-taking by the desks, syndication desks or proprietary desks at this bank, but rather emphasizes the fact that in new situations, people often neglect certain risks. So what I'm going to try to do is to go through the narrative of the crisis. Before I do that, just to put some connection to the crisis rather than Titanic, what might have been the neglected risks in the crisis situation, and I'll talk more about all of them. It's the magnitude of the decline of home prices, the sensitivity of security prices to home prices, something that I think Gordon Brown refers to as diversification myth, this idea that people thought that because of diversification, the CDOs and the MBS generally most safe, the magnitude of bank exposures and various failures of insurance. So what I'm going to try to do in this lecture is, again, to go through the standard narrative, focusing on some of these conceptual issues. I will focus on the four theories, and I will argue or try to persuade you that the first two of them, even though they do have a fair amount of currency, the 100-year flood and too big to fail, really do not square well with the data or the information we have by now. The comparison between the agency theory and the neglected risk theory is more complex, and there are pieces of evidence going in both directions. Of course, they're not mutually exclusive, and I'll come back to that toward the end of the lecture. Now, I want to say, and this is again a strong point of view that I want to take, there are people who talk, when they talk about the crisis still, and maybe that's one of the leading explanations, talk about the liability side of the financial institutions. They say that this was like a bank run, or a repo run, or a run on short-term paper of banks. My take on this, and I'll come back to that, is that the run has started, in our traditional model of runs, as in Diamond and Dybvig, runs are kind of multiple equilibrium phenomena. A perfectly safe institution can be vulnerable to a run. The run that we saw, if we saw a run, or some semblance of a run after Lehman, occurred after the banks were largely insolvent. Maybe they were not completely insolvent, maybe not all of them were insolvent. But it occurred very late in the game. And so it seems to me that if we really want to have a coherent explanation of what has happened, we need to understand the asset side. And maybe the liability side is the icing on the cake. But that's what it is. It's not more than that. Okay, housing bubble inflates. Homes are financed by mortgages that are increasingly securitized. Although the quality of mortgages deteriorates, the securities receive AAA ratings. So what was happening? Why was this perception of safety? Well, there are several pieces of the puzzle. The first one is, of course, there is this thing which we all understand, is that many of these securities, including CDOs, were receiving AAA ratings. And these AAA ratings were, given the work of Jarrow and given the work of Koval and his collaborators, was based on incorrect models. Okay? So it is already, the basic fact is already there, which is that, you know, there seems to be fundamental misunderstanding, or fundamental confusion among all the people who rely on these models about the nature of the risk. But no, this is not all. If you looked at the historical measures of volatility and risk, they all, of course, point to the security of MBS and CDOs. If you look at the price of risk in the financial markets in the summer of 2007, is at the historical lows. If you look at the expectations data that several people at the Federal Reserve have looked at, people understand that we're in the middle of the housing bubble. People understand that home prices can't keep growing and might decline a bit. But there is nowhere in the expectations data as a possibility of the fact that home prices might decline by something like 30%. And so if you look at these facts, it looks very strongly that it's not a situation in which people are somehow taking risks that they're aware of, but others are not. It seems like we're much more in a situation in which the market as a whole is not aware of the risks that are being taken by market participants and by financial institutions. Now, people like to reply to that is that surely there are people out there in the market like John Paulson or whoever who understood that there were risks and who bet against them because they were leaning against the wind, and so somebody understood that there were risks. That surely is true, but you know, John Paulson can lean against the wind. He can't stop the wind. The fact of the matter is the basic starting point of the crisis is that it seems to me that at least in the summer of '07, there is no evidence that people who were taking substantial risks were aware of the risks that they were taking. Now let me say a few words about a 100-year flood, which is you know, my version of kind of the sanguine view of the crisis, which is everything was fine, people understood the risks, they imagined bad things could happen, but they were just very unlikely. You know, the trouble with this story is that this happens all the time. It's not 100 years. A 100-year flood would be a good story if it happens once every 100 years, not when it happens every 2. In fact, we have evidence of similar cycles of growing leverage, deterioration of the quality of credit, and subsequent crashes. If you think about junk bonds, if you think about CMOs in the 1990s, those are examples in the last 20 years. Robin Greenwood and Sam Hansen have written a paper that comes up with extremely systematic evidence of credit cycles with deterioration of the quality of credit, increasing in leverage, and negative expected returns going forward on debt. If you look outside the United States, crises on leverage risk-taking are even more common. The point about this crisis is that in every situation, the risks that get people into trouble are always different. It's not that it's the same risk. It's not that the same situation happens with junk bonds or with the CMOs or with CDOs. The risks are different, but it is always the same feature, which is that there are some important risks that the financial system neglects. Because these risks are neglected, people are willing to make large leverage bets on these risks without fear. And then when these risks are realized or manifested, things come down crashing. Financial institutions such as banks and dealer banks retain substantial exposure to the real estate market, to direct holdings of commercial real estate, direct holdings of MBS and CDOs, but also implicit guarantees of special investment vehicles they organize, which hold MBS and finance them with commercial paper. Now, one of the absolutely, maybe the central themes of the crisis is that unlike in the internet bubble, the financial institutions kept an enormous share of the risks that they've generated. We actually owe it to the NYU collective, whom I have now renamed into the Stern Gang. Some of you will understand what this is a reference to. Most of you probably won't, but you can use Wikipedia. We owe it to them that they brought to our attention and emphasized this absolutely paramount fact about the crisis, which is that the banks kept the risk. Why? Now, one explanation is that they just wanted to avoid the regulations because, this stuff was rated AAA, and so the capital charges, regulatory capital charges against us were small. That's not really an explanation. It's an explanation of why they could get away with it. It's not an explanation of why they wanted to do this. So we need to ask ourselves, why is it that they wanted to bear all the risks? Now, one explanation is that they had to hold the risk as skin in the game and as inventories to engage in their normal market activities. But that there's probably a fair amount of truth to it. But we now know that, in fact, they chose to keep much of this risk, that they sold a lot of these securities to their own proprietary desks, which if they thought the stuff was radioactive, they probably wouldn't have been quite as relaxed about. We also know that they provided guarantees for special investment vehicles, liquidity guarantees, which in fact was an assumption of the risk that they must have thought was not something that was a terrible thing to do. So it sounds like they were more relaxed than the inventory motives would just suggest. Now, the second explanation that counted on the bailout, I'll come back to the bailout, the too big to fail argument, and I'll try to persuade you that doesn't make any sense. Of course, there are two other explanations. One is the agency explanation, and one is the neglect of risk explanation. So the neglect of risk explanation says that they didn't really think this stuff was incredibly risky. Certainly in 2007 and maybe even later. But the other explanation is that they believed, or at least the traders or the experts who were taking the risk, believed it was risky, but they didn't care because they were playing with their shareholders' money and they just had the upside and not the downside. So the reason I think we need to focus on the agency explanation or the neglect of risk explanation is because these are the explanations that get us started with this fundamental fact of financial institutions retaining the risk. Now, too big to fail, management knowingly gamble expecting a bailout. It's a very nice theory and generates a lot of excitement and outrage. There's really no evidence that I can think of that's consistent with it. If you look at the UBS shareholder report, it's pretty convincing on the proposition that the management was simply unaware, the top management, of the exposures in various parts of the bank to CDOs and to other mortgage-related securities. If you look at litigation around Citibank's third quarter report, it again seems very clear that the top management was fairly clueless. Now, you can neglect this evidence or disregard this evidence by saying, look, the UBS shareholder, the top management of UBS and top management of Citigroup have a very strong incentive to say that they didn't know anything. Take that with a grain of salt, but again, people, to the extent that people have done some investigation, that seems to be the case. Now, Fallenbrack and Stultz actually looked more systematically at this issue and asked whether the incentives facing the top management and the trading behavior of top management in any way correlates with the amount of risk-taking and write-downs that the banks have taken? And the answer to that, again, is no. So if the management knowingly was taking risks, you would think that the most strong predictors of managerial incentives would give you some predictive power for bank behavior, and the answer to that is no. If you look at the banks that seem to be a little smarter in this episode than the others, their management, as soon as they smelled trouble, tried to get out of these positions. And finally, and this is a bit of a psychological argument, a number of people said, look, nothing terrible has happened to the management of these banks. After these banks went under, they still got away with a couple $100 million. So there couldn't have been severe penalties for going under. This is used to be as an argument for too big to fail. That may be true, but it's also the case that instead of having dinner with the president and playing golf with the president, they're going to be having dinner and playing golf with their lawyers for the next 10 years. And I strongly suspect that that's not how they wanted to spend the rest of their lives. So I just find no evidence in support of too big to fail arguments, and a lot of evidence going in a different direction as well as theory. Bad news about the housing market in the summer of '07 surprises investors, precipitates a sequence of substantial disruptions in the market. But the Fed interventions seem to be successful. Market stabilizes for at least a year. Now, this to me is actually, in thinking about the crisis, is the most interesting period. The period between the summer of 2007 and the summer of 2008. As I will try to argue in a few minutes, I think the post-Lehman component of the crisis, we as financial economists have the tools and have had the tools to understand extremely well. Not completely, there are many puzzles, but I think that period we have a way of thinking about. I think the mystery period is this year when things are going sour, but people seem to be extremely calm. Now, why are they so calm? The bad news about housing in AAA-rated MBS starts to appear in the summer of '07. There are several bankruptcies of hedge funds and banks, including Bear Stearns. The ABCP market collapses. Some banks sharply reduce their holdings of these securities, but others stay put. UBS, in particular, and Citi did not engage in any reductions of their holdings of consequence. Banks appear to be raising capital, but very, very slowly. And the Fed lends against risky collateral, so it intervenes quite aggressively. But it doesn't really force banks to raise too much equity. So why was the response so timid? Now, the most obvious explanation is, we need to remember that in the summer of 2007, home prices haven't yet fallen 30%. They've only fallen 10% or what have you. And so it may very well be the case that the rational response to what has happened is not to panic, because nothing terrible has happened yet. But there are other aspects of it. Bank accounting, again, as you can see from the UBS shareholder report, was clearly hiding losses. But perhaps most importantly, neither banks nor regulators at this point seem to have understood what was happening, in particular, what was the exposure of banks to these markets. Okay? So again, the most natural explanation is an explanation that has to do with this fundamental lack of understanding. Now, the Fed, to its credit, the officials are now quite honest about this, and they say we didn't understand very much in 2007. The banks, of course, except for UBS, we don't know much of what has happened inside. But again, this points to the fact that maybe it was not entirely the agency problem. Now, a couple more things that are very relevant with respect to what I call this mystery period. The biggest losses that banks have acknowledged, the banks have realized, the biggest write-downs that the banks have had were in CDOs. I think the fact from Ben Malik and Lugosz is that 42% of total losses were with CDOs, in CDOs. Now, CDOs are also the stuff for which everybody had the wrong model, right? Where the correlations were not modeled properly and where the sensitivity of prices to correlated risks were not modeled properly. Is it a coincidence? Or is it the fact that the right model to think about is the model in which people don't fully understand the risks and act rationally given their understanding? Now, one other point, and again, this is more a rhetorical point, but I do find it somewhat compelling, which is that, we're now in the summer or fall of 2007 or the spring of 2008. The management of these banks, certainly the management of UBS, is asking a lot of questions. I find it very hard to believe that the management, if you believed in the agency story, could not figure out the risks that were being taken by these banks, if in fact it was merely the information asymmetry between the top management and the risk takers. In other words, if the people who were taking the risks in these banks understood the risk they were taking, but the top management, but were hiding them from the top management, it is surely the case that the top management had enough knowledge and resources to create some accountability. But despite that, we see that the banks are being relatively calm and passive. And I think the best way to think through this, to think about these facts, is that people don't understand the underlying model. Okay, in September 2008, several events, including a run on money market funds, nationalization of AIG, Fannie Mae, and Freddie Mac, and particularly collapse of Lehman, precipitate a massive crisis. Bank balance sheets contract because of massive losses on assets and withdrawal of short-term financing, which prompts banks to liquidate assets in fire sales. The consequences of these fire sales are exacerbated by uncertainty about bank solvency and government policy. Now, this part I want to talk about very, very briefly, because I think this is the part that we as a finance profession actually were prepared to understand, understood, that could talk about very intelligently as soon as the crisis occurred. This was the difference between macroeconomists and financial economists right after the crisis, where the macroeconomists had very little to say, but financial economists had a fair amount to say. What did we have to say about these episodes of massive losses, withdrawal of short-term finance, and fire sales? Well, again, we have more or less well-accepted models of liquidity, of fire sales that suggest that if a bunch of specialists try to dump on the market similar securities all at the same time, when the cost of short-term financing rises, you're going to have elimination of liquidity and you're going to have prices falling substantially below fundamental values, which seems pretty much what has happened. Now, let me say again, just an aside of another alternative theory, which is the role of short-term debt. Again, I do not want to deny that post-Lehman increases in margins or increases in the cost of short-term debt or outright withdrawal of commercial paper and other short-term financing didn't play a role in making the crisis worse. But again, I want to make a couple of points to suggest that this does not look like a regular run. The first point, which is quite important, is that repo is collateralized. So the standard problem of generating a run, which is that you have a common pool of assets and people have claims on these assets and they try to be the first in line to get their money out, simply does not apply to repo market, where a lot of these problems took place. But I think more importantly, the problems on the liability side do not occur actually to any significant extent between the summer of 2007 and the fall of Lehman, and they really occur and the last stages of the crisis. And if we want to understand the crisis, we really want at the most fundamental level understand what happened before and how we got ourselves into this mess. Now, in response to their losses and to reduced availability of financing, banks cut lending to firms. The economy slides into a major recession. Why did banks cut lending to firms? Again, I think we have pretty good answers. It's the usual credit supply channel. I think some of the things that were very interesting during the crisis is that banks were also hoarding cash, something that Raghu and Doug Diamond have written about, but they also were buying securities. And that also is, by the way, very consistent with the fire sale point of view, because if you think about banks allocating their scarce capital among alternative uses, and if you think about them deciding whether to hoard cash, to buy securities, or to lend to firms, if the security prices are dislocated, if the securities are too cheap, or some of the securities are too cheap, and you give the bank some money, the first thing they're going to do is invest in securities, not lend to firms. And so that's in fact what they did, and that's what the evidence seems to suggest. But again, this is not something that's we don't understand. Now, there's been a very interesting discussion in finance about whether the cuts of lending would just influenced by the shocks to banks, or whether there was also reduction in the demand for credit. One interesting, just a footnote on this, is that we saw reductions of bank lending and recessions, even in countries that didn't have housing bubbles, that didn't have substantial securitization process, that simply had banks that had exposure to these securities. So bank lending channel may not have been the only channel of the reduction of bank lending, but it certainly was an important channel. Government interventions, again, I want to go through this very quickly. It's actually an extraordinary success of government interventions after Lehman. Now, you can say that letting Lehman go was a disaster that no subsequent intervention can clear, but it is still the case that some combination of lending against risky collateral, institutional rescues, buying securities, and guaranteeing money market funds has been very successful. The one thing I want to say with this respect is, again, to the extent that you actually do think that there was a liquidity dry up and a fire sale, all these policies make a lot of sense from the theoretical point of view, and maybe we should not be surprised they were so successful. Okay, so let me summarize and then get to the interesting part, which is where do we go from here. We have a good theory of crisis after Lehman, much less good theories or compelling theories of how we got there. Agency and neglected risk are the two most credible explanations, but neglected risk or false models, whatever you want to call it, seems like the most parsimonious model, which is consistent with the basic evidence on ratings, consistent with the expectations data, consistent with our ideas of how people take risks when historical volatility has been low, but it's also in a very important way consistent with the relative passivity of management and regulators in 2007, because I think the only way to understand it is really to focus on. And I think this is important, although I don't think this has been worked out, is that it's the combination of agency and neglected to take risks that they understand they're taking. They might want to be hiding them from their superiors, but they understand that they are taking these risks, and they understand that maybe the upside is better than the downside, and they're willing to take them, so they're willing to take them to a certain extent. It is quite another matter to have a framework in which people are taking risks without understanding that they're taking them. Because in that world, what they see is arbitrage. or near arbitrage. They see opportunities to borrow money and invest in securities where the cost of funding their position is substantially below the returns on holding these securities. And you can, of course, easily get people to take enormous amount of risk, and to take enormous amount of risk with leverage if they're not understanding the risks that they're taking. And my guess is that that's probably the real story of the crisis. Now, if I convinced you, even a little bit, that neglect of risk is an important feature of reality, then there are many problems for finance to address. And I just want to talk about a few problems related to general theory, to financial innovation, to security prices, and maybe to regulation. Theory, this is, as far as my own research is concerned, is something I'm most excited about, which is we don't really have standard models of neglected risk. And when I say neglected risk, is that you literally attach zero probability to certain events that happen to subsequently materialize. Nicola and Giannaioli and I have developed a set of ideas in this direction, which we call local thinking, which basically, at the most general level, have this idea that people optimize, but rather than optimizing considering all the possible states of the world, they optimize on the represented state space rather than the complete state space, which is that they overweigh some states and they consider them to be more likely, and they underweigh or neglect other states. Now, how does the representation of the world, how does the represented state space come to mind? We have some ideas which we've written about on how salience, representativeness, and basically recall of information from memory can influence how people represent the world. It turns out that this approach can be used to analyze many, many, many very exciting things, maybe very esoteric things, like the lay paradoxes, the famous Linda problem of Linda being more likely to be a feminist bank teller than a bank teller, and so on. But it also can be used to discuss financial issues such as the ones we've talked about today. But this is just something that we've started to scratch. Wanted to bring it to your attention because I think it's quite exciting. Now, financial innovation, I think this is where the application of these ideas is in some sense most immediate. Now, our usual argument for financial innovation that goes back to Steve Ross's paper on options in 1976 is that it completes financial markets. It gets us closer to Arrow DeBruce securities. Now, that argument rests very fundamentally on the assumption that people understand the world. When people do not understand the world, when they hold incorrect expectations, what you can get is that financial innovation misallocates risks and leads to creation of false insurance and stability. And again, the idea is that people will invest in securities that they think are earning them good returns. They don't understand certain risks. They're going to buy a lot of these securities because they're going to look like a very good deal for them. And not only that, it's going to be very strongly in the interest of the financial system to create and generate these securities because there is so much demand for them. And so as a result, people who have no business bearing the risk or no capacity to bear the risk end up bearing a lot of it without suspecting it. And of course, once they realize that these securities are risky, they try to get out, and all kinds of adverse consequences ensue. So I think financial innovation looks very, very, very different in the world in which people don't fully understand the risks than in the world they do. Now, again, what's the message of this? Am I trying to say we shouldn't have financial innovation? No. Just like I wouldn't say that after Titanic, one shouldn't try to have bigger ships or better ships. But one would probably say that if you're building a ship that is bigger and that is different, is made with different materials than the ships that have been previously made, you probably would want to test it a great deal more than you might otherwise, and you might not put 2,200 or whatever it was, 3,000 passengers on it right off the bat. And so there are things that one can do in terms of the exposure of institutional investors or the exposures of others to the new products, concentration requirements, and so on, that probably do not involve banning financial innovations, but that involve very similar practices that you might use in the case of a ship. And again, I want to emphasize, I want to stress that all the people who were involved in building, organizing, making decisions with respect to the Titanic died. Okay, so thinking of these problems as pure agency problems might not get you where you want to go. Let me make another point with respect to financial innovation, and this is some of the recent work of Alp Simsak that's been kind of on the horizon of some of the behavioral research for a number of years, which is that one of the other consequences of financial innovation is that it unbundles risks. And so if people want to make strong bets on particular outcomes, it makes it much easier to make these bets because you can take much purer bets. If you think speculation and leverage are always a good thing, that's excellent. If you think some people are doing things they're not supposed to be doing, it's less excellent. Okay, I'm very close to finishing up. Security prices, I had to get that in. Now, to me, the efficient markets is not really any more than an empirically interesting hypothesis. We have much better models. We have much better theories. But, if I look at behavioral finance over the last 20 years, the idea of limited arbitrage has been much more successful than the idea of investor sentiment. We still don't have anything like a good, consistent, plausible, unifying theory of how investors think. The question is, what can be a viable alternative, or can local thinking be a viable alternative? Well, it could be used to explain why risks of low probability events in the run-up to the crisis were neglected. So I think it could be helpful in thinking about the crisis. But it also helps explain, and that's part of this theory, is that why some salient risks, including very unlikely but salient risks, get overemphasized in the market. So if you think about the value stock controversies and various things that emerged from this, one of the points that, one of the issues in the debate was this idea that Gene Fama and Ken French had, that maybe it's that wasn't called bankruptcy risk, it was, what did they call it? That the value factor was the distress risk. And there was a slight problem with that there was no evidence of distress. The point here may be that what's relevant is the perception of distress, not the reality of distress. And so you might, in fact, unify a great deal of data if you focus on exactly how people form beliefs. Finally, let me say something about regulation. This is my next to last slide. There's been all kinds of issues, all kinds of proposals about improving a financial system, most of which I agree with. But one issue that has kind of fallen by the wayside is the issue of mark-to-market accounting. Now, the usual justification we have for mark-to-market accounting is that we want the outside investors to firms to be informed. It's useful for corporate governance, it's useful for outside finance. What I think the crisis made clear is that a lot of the problems with the lack of mark-to-market accounting are internal inside firms. And I think if you read the UBS report, at least if you read it the same way as I do, you'll come away with a feeling that it was precisely the rejection of mark-to-market accounting that enabled banks to delay acknowledgement of risks and enabled the perpetuation of the myths that what they had is a liquidity problem rather than a problem with enormous reductions in the value of the securities. So I think that the argument for mark-to-market, whether you actually believe in agency or whether you believe in neglected risk, is much more compelling if you look at it from the internal financial firm perspective, even than it is if you look at the external perspective. So that would be the pitch that I would make, or the lesson that I would learn from this kind of approach. So those are the three punchlines. The neglect of risk, which seems to be a potentially interesting and new direction for finance to pursue, seems to be a key theme in the crisis, a very key element that unifies many pieces of the financial crisis. If it is indeed the case that this was important, then improving incentives may not suffice. The best ideas that one can have, ideas about stress tests, particularly, I very much like this Darrell Duffy idea of stress tests that don't rely on bank estimates or probabilities of various outcomes, but also maximal transparency that might facilitate the recognition of risks. The other key theme for the post-Lehman part of the crisis is fire sales. And I think the basic message of this, and again in sharp contrast to the too big to fail models, is that the policy direction that these fire sales models point to is a tough regulatory policies ex ante, but soft policies ex post, which seem to have been so successful in 2009. Thank you.
Thank you very much. I think we have time for a number of questions from the audience. Would anybody like to ask a question? Why don't I start with a question then? Andrei, you talked about a 100-year flood, and you said problem is it occurs every 2 years, and people should be recognizing the fact that it happens every 2 years. Well, couldn't you make the same argument about the neglected risk model, that if the risks change, but it is neglected every time?
Yes.
Shouldn't we start wondering, is this a sensible way to think about innovation?
Well, again, this is a very good question. And if I stood here and I said that the regulatory regime that we want to introduce is one in which the Securities and Exchange Commission or the Federal Reserve tries to assess in advance whether a new financial product is vulnerable to a new risk that the insiders in the financial system have not identified, I would say that's probably not a viable policy. However, I didn't go there precisely for that reason. And what I said instead is that it seems to me that if you're a regulator, what you want to worry about is that if you have a new product and there is a theory and historical evidence that suggests that this product is safe, that's fine. You don't want to ban the introduction of that product. But you also don't want to get into a situation in which regulated institutions or fiduciaries in the financial markets end up exposed to this new product in a short period of time in a way that can bring them down. Okay? That seems to me to be a perfectly reasonable compromise between putting the burden on the regulators of knowledge that they certainly cannot be expected to have. I also do not like these policies of, people have advocated the FDA approach, in which you have, 12-year waiting periods for financial innovation. That doesn't sound very reasonable. So I'm all happy for there to be financial innovation, and I'm all happy for people to lose money on it. I just don't want them to lose so much money so fast, and that seems to be a perfectly viable regulatory strategy.
Other questions? Right there.
right? When we say that CEO's empire built, we don't say that they knowingly know that it's a bad deal for the firm, and therefore we buy or buy firms. We say they start with completely, right? But we still recognize that they have incentives to do that and capitalization costs. When intermediaries neglect risk in a way that clearly comports with their incentives, don't we want to think of that really as a kind of agency cost? And my last comment, it's a little bit unrelated to those two, is I think you're mischaracterizing the too big to fail story a little bit. I don't think it's about intentional expectation of a bailout by bank managers. I think the compelling too big to fail story is story about creditors, right? The bank managers look for cheap financing, and creditors perceive a too big to fail guarantee and provide financing with a substitute cheaper on the expectation that creditors will be getting.
Okay, you want me to? Okay, let me just, there are 4 questions. So, end investors versus intermediaries. I should have been clear on this. It's what happened here in the crisis, I believe, is a situation, which is why it was so devastating, is where the intermediaries were confused as well. So if I had more time, I would talk about the difference between the internet crisis, where the intermediaries were not confused and writing funny emails to each other saying what idiots the investors are, and the financial crisis in which, as I said, the fundamental Stern Gang fact is that half of the risk was kept by the intermediaries. So I think that, that's probably the more plausible model. On agency cost intentional, I'm not sure I understand. I mean, it seems to me the agency story, the most natural agency story, as I understand it, is that the traders understand that this is risky, but it's worth it for them, even if it's not worth it for an organization. Now, there is another, people like to tell that story about Citibank because I guess it's fashionable to say very bad things about Citibank. That there is kind of an alternative, non-economic agency story that neither the management nor the traders cared. So it wasn't that they knowingly took the risk, but, it's just they thought they had a good payoff, the management didn't care, whatever. Again, I tend to give people a little more credit. It seems to me that, again, the story that we have in economics of agency, the basic story is the story in which the agent has superior information that the agent hides from the principal, and doesn't seem to be a very good description of what has happened in the crisis. Now, on too big, so the agency costs I'm referring to are the agency costs in intermediaries, and I mean, they surely are part of the story, but it seems to me that confusion or neglect of risk has to be another important part of the story. And finally, on too big to fail, again, what I take to be the heart of the story, I mean, if you think that the management of these institutions understands what's going on, whether it's on the asset side of the balance sheet or on the liability side of the balance sheet, and if they understand the risks that they're taking, okay, either they willingly bear these risks, or what I take to be the substance of the too big to fail story, they think that if bad things happen, things will be okay for them. Okay? And I just don't think that there is much support for that story, as I tried to explain.
Other questions? Out here, Christian.
Question I have is, it seems like in the local thinking model or in the neglected risk, there's huge incentive for people to kind of think the unthinkable, right? So think about what people might not be thinking. And so could you talk a little bit more about these forces and why they're not going to be, why there aren't internal forces that then would try to mitigate the neglected risk problem? And is it sort of a similar story that we see in behavioral models where there's enough local thinkers that even the sophisticated people have some incentives to go along?
Well, this is, I think, well, I don't know. That's sort of a higher level argument. I would say that there are 2 points. The first point, which is the obvious point, I think, is that, the world is such that we often don't think of things. You know, there are incentives to think of things, but a lot of the events that take place are not things that we've considered possible or have anticipated, and maybe we'll understand why that is, but I don't have a deep answer to that. The other answer is that the one you gave, which is that surely there were people at some point, and you know, Michael Lewis said this much better than I can possibly say it, which is there certainly were people who thought that this was crazy, and they made bets. And some of them had mental breakdowns, and some of them lost all money under management because the bubble lasted for another 2 or 3 years. And it doesn't sound like many of them, other than John Paulson, who got into the fray relatively late, have ended up doing so well. But again, you know, these are deep issues that, you know, the reason that I said in the theory parts there are many issues that remain unresolved. I think the finance piece of it we can talk through as you did, but the deeper part of it I'm not sure I can get answer.
One last question, if anybody wants to ask the last question to end the session.
Okay, so
as you mentioned, it seems that financial innovation could be good or bad.
Right.
So market accounting has the same two aspects.
again, I was thinking about financial institutions, and I was thinking about my mystery period, you know, from the summer of 2007 and 2008. And I was trying to ask myself the question, if banks, particularly banks, were forced to carry this or to recognize the losses on the full range of securities and investments that they had earlier, would it be the case that A, they would have been first of all, the management might have forced the risk takers to sell positions earlier. Second, they would have been more aggressive in trying to raise external capital, and so on. And it seems to me that one of the reasons that the response was so lackadaisical during this year is precisely because the lack of market prices in the accounting system delayed the recognition of many of these large institutions which had exposures in many parts to the same risks of the aggregate risk they were bearing. So from that perspective, it certainly shifted my priors in favor of mark-to-market accounting quite a bit.
Thank you very much, Andrei. And I think from the quality of the lecture and the audience that stayed behind to see it, we probably will have a successor lecture. Thank you.